Good morning. This is Mijanur Rahman from Toronto. Today is June 5th, year 2019. Yesterday, on the video number 6, I talked about decision-making process. And where we left off is that the possibilities of financing your business. So we left off where or if your business is ready to take off. So now, from the recap from the previous video, as mentioned, is that now business forms nowadays with professionals, with management team in place, and experts in a management team, a group of experts, and they form large business, and they go public. Now this has been quite a this has been very traditional model. It has been becoming a traditional model over the last decade or so. It had been, or have been. Now, before you talk about the new financing, how my ideas on it, I wanted to talk about the traditional financing. And before you wanted to see whether before you take off with our business, going public, going multinationals or global, or whatever the settings might be, we want to check the safety checks. So today I actually got myself a pen. So costed me $1, I guess. But anyway, so I make some notes today so that I can share those safety checks with you. So before we get to that, I want to talk about the safety check. So what are the safety checks we need to make sure that we have it in place, or you have it in place for your business? So the safety checks that contains is that the cash flow from your operation, your business, whether it's positive. So cash flow is something that I always talk about. Cash flow is something, it's called blood. It's a blood in your system. So if we have a body, it needs blood to run the brain, the fuel for our body. Food is the fuel, but the blood is that keeps everything alive. If the blood stops flowing, we die, right? So same thing in a business. If the cash flow from the operation is not positive, if it is not flowing, then the business will die. It will have a going concern. So unless it's a very specific niche type business or research and development that requires certain time frame to take off, otherwise, a lot of underwriters, a lot of securities regulators, before they pass that, before they let you go public, they have some safety checks, and this depends the regulations by regulations, country by country, and the regulators by regulators, and also the underwriters. They have their own criteria of assessing risk, right? So The regulation is mostly the legal point from the points, and the underwriters is basically they address the business risk, all those risks where that the underwriters, they will assess whether actually whether your business is ready to be financed publicly or other methods that are available to you. Now, the another option that the another safety check number 2. So number 1 would be whether business is providing positive cash flow from your operation, right? Number 2, whether you have the ability to meet your current obligation or obligations from long term that is due either by covenant within a year, that's current liabilities, whether your business has the sufficient cash or ability or liquidity to pay those. And that's often the ratios comes in place to check those, whether you have the solvency, whether you have the ability to pay your dues, current obligations on as they incur or as they're due. And so number 3rd is that the whether the business has any credit risk, right? So whether your business is downgraded because of the credit risk, right? So often businesses has the businesses are rated by a credit bureau or credit rating agencies, and they are placed within a credit score, and this score. Well, let's not talk about the credit score today or credit rating, but let's know this, that if your business is poorly rated by a credit reporting agency or credit bureau or credit rating agencies, you might want to think about your business risk. Then you'd also have to look at whether your collectibles are assurable, whether you have assurance in your collectibles, meaning is that whether your account receivables are legally collectible, or whether they are from the historical point of view, whether because you would have to pay your loan, the money has to come from somewhere, right? And if you're selling and if you're not receiving your account receivables, then what's the point of getting into business, right? So you'd have to make sure that your account receivables are actually following schedules or aging methods criteria, and whether you have any safety in place or some sort of team in place that is actually responsible for collecting your account receivables on a timely manner. So let's recapture that. 1 is that your cash flow from operation. 2, whether the business has current obligation that is due. Whether number 3, whether your business has credit risk, and number 4, whether your account receivables are collectibles, can be collected on a timely manner. Number 5 is that number 5 would be something that I wanted to talk about, your ratio checks, to make sure that you are solvent, where your asset to the different ratio, your current ratios are and your ratios, that is your solvency ratios for your financial statements, your working capitals, and also the ratios from the long-term asset and liabilities. That's something that you got to take a look at that, and also you'd have to take a look at it's a good idea. You know what? If you really look closely, if you go to a bank to apply for a loan, they have a whole bunch of listing for your ratios. also, if you're listening to these videos, if you have done your corporate financing, I think it's most likely in course 2 or second course or third course that deals with corporate financing, and you probably deal with a lot of ratios there. There is a whole chapter that deals with a whole bunch of ratios. I'm not a very big fan of it, but those has to be checked, because sometimes numbers actually provide some sort of indications of how well you are doing and how well the corporation is doing. So that is something that's a good idea. And number 6 would be very, very, very important. Who are your auditors, and what kind of opinion they've provided on your financial statements? Because you don't want to waste your time going to the underwriters, because it's very cost effective. And if you have an adverse, opinion by the auditors on your financial statements, what's the point of wasting time? So you want to make sure that your financial statements, the auditors, that opinion that is provided it's unqualified opinion, meaning is that they have no opinion, and the financial statements have been prepared based on the IFRS, which is IFRS stands. A lot of people know that what IFRS stands for. It's an accounting policy. So previously we used to follow GAAP, generally accepted principles. So it has changed to IFRS. So this financial reporting standard, they want to make sure that anything abroad, everything within that is trading in worldwide, they actually follow this IFRS. It's actually a good idea. It's really an amazing idea, and I think it is an absolutely phenomenal idea for business to be measured or recognized, or they have a certain evaluation or certain recognition criteria or policy in place that would provide a certain standard to analyzing the financial statements, and that is the IFRS. Now, this private nowadays, because of the gap is gone, so they use the P gap, private entity gap. Often you might probably have that. So let's say if you are a mid-sized company or a large company, but you're not sure whether you would have an audit, whether you would pass the auditing, and you would have an unqualified opinion. So you want to ask that. So if you happen to choose a big firm at the very beginning, a reputable firm, accounting firm, they would be able to provide you with certain guidance. So maybe they'll provide you on the review engagement of your financial statements, where they would probably tell you exactly what you need to do, whether they'll give you some sort of signal, some sort of indication that, hey, your accountant might probably would say, hey, look, I think it's a good idea to get an audited statements done. And in fact, a lot of business, even a bank nowadays, even if you're to finance your business privately, they also ask for the audited financial statements. Now, these audited financial statements may often I come across quite a few of them. They don't meet the IFRS standard, but they're audited financial statements. So I saw I come across some of those financial statements without mentioning this corporation's name or the preparers of the accounting statements. There wasn't sufficient notes disclosure. There was a revenue recognition problem, the expense matching problem. There were a problem with the poor disclosures on the conversion of the long-term liability to the short-term liability to a long-term liabilities. So there was a problem with the tax, recognition of tax liabilities and tax expenses. So actually, if you look at the financial statements, the tax assets, tax liabilities, and tax expenses, tax payables, a bit complex because of the IFRS. It just became slightly complex when we decided to adopt the IFRS. So that is something that you need to look at it, whether your accountants or your legal teams are okay, where they're working side by side, or your financial advisors or financial planners. In this case, if you have a bank, then if you have if you're working with a bank or financial agency or financial firm, there are financial planners. Now, be careful with this. A financial planner they have more product knowledge than often more than an accountant or probably legal side of it, because they deal with a lot of products in the market, right? So, and this guy could have a securities license, or they might be licensed through, IIROC in Canada, or they might have combination of IIROC or the securities license, insurance license. They might have a CFP, they might have a CFA, they might have accounting on top of that. They would have accounting certification or designations. They would have often. They might have a chief. They might have written chief compliance officer examinations. I had to write that. They might have written. It is very important that you look at this, right? Because they have a lot of product knowledge, a financial advisor or financial planner, so they could, guide you to the right direction. And in fact, they could actually introduce you with the investment bankers or investment dealers, right? So, because these guys really work with the investment dealers, because you're not your bank, but banks. We'll talk about at some point about banking policies. Bank Act and so forth, but let's not get to that today. I will talk about that. But so your financial planner or financial advisor or your financial guy is highly connected with your investment dealer. Actually, is part of the integrated part of this investment dealer. So it's a good idea to have a good relationship with your financial planner, right, or financial advisor or your bank manager. It's a good idea to have that relationship. Now, I'm not talking of relationship other than the legal bona fide relationship. I'm talking about legal bona fide relationship where everything measures up and is standard, and everyone meets the fiduciary and duty of cares to each other. So that was number 7, which is the financial statements has to be, you have to get that vibe from this is the safety check, right? Because you don't want to incur cost by, hiring an audit team, and then you look at that, you don't meet the IFRS, you can't, you're not profitable, your operation has no money, there's no blood in your corporation, there's no blood flow, which is the cash flow from the operation, there's nothing there. So what's the point of, wasting your money, resources, and creating a resources scarcity? So that's something that you want to take a look at that. So another thing is that your underwriters. So often your financial planner probably be connected with underwriters, right? So this is one of the main reasons you really want to be connected with your financial planner or financial advisor, securities advisor, because it is very important. This is who will introduce you. Often could be your accounting firm if you don't have a large accounting firm. So they might, he might know some underwriters. And in this case, so often large accounting firms also work as an underwriters as well. So often insurance companies, they might have an arm's length, underwriters that they work with. So there's something that you need to be aware of. So if you pass the standard, the audited standard of the IFRS financial statements, then you need to make sure that you have a good team of underwriters in place. So if you need only one, then fine. But if the underwriters feel that there's a lot of business risk and credit risk, a lot of risk for them to take on the deal by themselves, or the offering is really large for taken by one underwriters, then in that particular case, the main underwriter might probably hire secondary and the other underwriters to help them with, depending on the expertise. So not all the underwriters, they have expertise. So depending on the area of the business, you might have to choose the right type of underwriters. And the main underwriters then will look at it and then assess their business risk, and they assess their business risk and probably hire the other underwriters to help them with the underwriting process. And they'll probably, let's not talk about the underwriting today, we'll talk about another day. Let's talk about a safety check. So you want to have a bit of conversation with the underwriters, and you probably want to give them your financial statements at the very beginning, have some, have someone to look at it and provide you some sort of opinion before you incur any cost, because you want to get some vibe and say, hey, I have some financial statements that are audited, and would you like to provide me with some sort of feedback? And at this point, you don't want to incur any cost, but it's just an opinion basis. There will be a lot of underwriters, they want to take a look at it at a fee, and they want to provide you with some sort of opinion, I think without incurring any fees. But those opinions may not be, they might want to say they want to be liable for that. They probably want to give you some sort of rule of thumbs of indication. But once you hire them, they'll probably provide you with all those. Again, these underwriters, they have a different contract. They might work on a contract basis. They might take on a best effort basis. They might take on a, or whatever the security sells. So, but you want to talk to your underwriters. They might have different policies, or the fee cost, or they might have different standard of doing business. So someone might say, well, we'll go on the best effort basis, or we'll buy the entire stocks. Well, or you might want to pay us some fees in advance before you make the decision to whether we want to work with you or not, right? So because a lot of time consuming for them to go through, assess those business risks for them, underwriting risks for them. So that is something that you want to get from your underwriters. So and then, which is the number, I think it was number 7 or 8. I may have missed one number, but anyway, okay, so that was actually number 9, the arrangement that your underwriters offer on the opinion that the underwriter offers to you, or as business owners, or to the business management or the management team, whether it's a green signal you have to go ahead with the underwriting. So that's something that you want to consider that before incurring any cost, right? And also at the same time, you want to see whether you have any private financing that is available to you as well, because sometimes going public could be really expensive, and you may not have sufficient amount of offerings or the shares available or outstanding or authorized, right? So you want to make sure that you have looked at the opportunity costs for the financing. Now, these are all traditional way of doing business, traditional way of underwriting your business. So this is not something that fancy as of yet. We haven't talked about the fancy stuff yet. But this is really basic. It's a really usual stuff that people really deal with on a daily basis, on an ongoing basis, in a traditional way. So that was number 10 or number 9 or 10 on the whether you want to get an opinion on the private financing, right? So there's a different kind of private financing. You could go to you could probably go to investors and sell them shares privately, or you could I was watching a show on a TV show. I think it's called the Dragon something. I can't remember what this show was, but anyway, they have some sharks, and they actually invest in your business. But I would really be very careful with this, doing business with private financing. You don't want to lose control, right? So that's something that you want to take a look at it. But if the cost of doing business is really less, then why not? And if it is the right team, yes. If it's the right guy, if they have right expertise, then they might probably want to get some shares and ownership of your business, whether they have a controlling, whether often they might say, well, we want to place a clause with the borrowing that we want to get involved in decision-making process, or some sort of covenant, some sort of regulation, some sort of contract they might have. And they might also want to say, well, and you have to meet the certain ratios, certain profitability to maintain the financing. So if it is the debt they're offering, then they will say, well, if business is doing well, then we want to convert that into shares. And if the business is not doing well, we want to try that into, convert that into some sort of shareholders loan or some. But you would have to take the legal side of it, the converting. If they are buying the ownership of the corporation, and later on if they want to convert, if they have the right to convert that to a bond. But it's very rare at these options. So maybe offered through the preferred, similar concept as a preferred shares. So you want to take a look at that. That is something that you want to make sure that you have the safety check done. And very, very important, number 11, which is whether you have a good and expert management, on board, whether the management team has sufficient knowledge, expertise. And nowadays you could say, well, your business has over 100 years of experience in combined, right? So you might have 20 guys or 30 guys or 10 guys worth of industry, about 20 years of they have significant knowledge about the industry, and they're really, really on the top-notch professionals or experts, and those are really valuable asset, right? So that is something that you do want to look into it, your management of your business. So that's something that you want to make sure that you have the right management on board. And secondly, that whether you have any incentives, whether you offer good incentives to your management team, and whether they are, what kind of incentives they are offered, whether they have private pension plans, whether they have, often nowadays, I talked about in my first book, individual pension plans and retirement compensation agreement, RCA. Often these are offered to the management teams. These are really, really good programs for the management teams. If it is really good expert, you might be able to offer that individually as well. So often these are in place, deferred compensation program and so forth. Also, this is something that you